The growing inventory of homes for sale in this country has dramatically slowed. Just a few weeks ago, I assumed inventory would keep surging well into the summer. I assumed that buyer demand had backed off and inventory would pile up. But now in mid-August, the market is showing us some very different evidence about the American homeowner. Homeowners aren't interested in selling into a weak buyer environment. They're nervous about the economy, and they have their super cheap mortgages to keep forever. If I don't have to sell, I don't sell. As a result, it looks like now we'll peak inventory at about 600,000 homes on the market this summer, and probably end the year at about 525,000 homes. That's less than we were modeling just a few weeks ago. Each week, Altos Research tracks every home for sale in the country. We analyze all the pricing, supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. If you aren't using Altos market reports with your clients, your buyers and sellers, now might be the time to step up. Go to altosresearch.com and book a free consult with our team because everybody is worried about what's happening right now. They need you to help them see clearly. I'm Mike Simonsen. I'm the CEO of Altos Research. And here's what we're looking at for the week of August 15th, 2022. This week, available inventory of homes for sale climbed just over 1% to 550,000 single-family homes active, unsold on the market right now. That's 30% more than last year at this time. What's interesting is that last year, mid-August, inventory was climbing faster than it is right now. We added 6,000 net new listings this week, where mid-August last year, we added 11,000. You can kind of see that in this chart here, where the bump in the curve for last year was still rising in mid-August, but this year we've turned the corner at the far right end of the chart. When thinking about how high inventory will grow or not grow, the wild card here is how much of the new construction in process will complete and when will it get listed for sale. We have record numbers of homes under construction in the U.S. So maybe we get some unseasonal lift in this year's curve late in the year. If, for example, those houses hit the market in September or October. But assuming we're back on track to what appears to be a more normal seasonal curve than we've had in a long time, that would imply that inventory reaches its 2022 peak in late September at about 600,000 homes before falling back to 525 to end the year. So if you recall, just a few weeks ago, I estimated maybe 535,000. And some very smart people suggested at the time that the projection was too low. But it turns out fewer sellers have been listing each week than our model projected. So the weekly model still allows for some pretty big weekly inventory gains over the next month. So this projection could actually end up lower still if that trend continues. So see the dotted line here for the weekly projection of this curve for the rest of the year. Inventory levels are still below 2020. You can see here, just 2 years ago when that pandemic buying frenzy started and available inventory dropped so rapidly. But sometime in the next couple months, we'll break up above that line. I don't see anything in the data right now that suggests we're going to get back to those old levels, those healthy levels of inventory anytime soon. The higher curves on this chart, I don't see when they would happen. One scenario where that might happen would be if we had a big, deep recession with a lot of unemployment. This week on the Top of Mind podcast, I sit down with Darren Blomquist of auction.com and dive into their data on the dynamics of the distressed mortgages, which we don't have many now, but we would in a recession. Darren shares his insights about how long it takes between that recession and when we might see some more inventory in the market. That podcast drops later this week. It's going to be great. Check it out. Keep your eyes open for that one. Meanwhile, prices are holding steady for August. You'd actually expect this nationally for August. The median price of single-family homes in the U.S. this week is $449,000. It ticked down just a fraction this week. My expectation is that median price of homes should start ticking back each week now between here and the end of the year. Likely end the year about $415,000 median home price. That'll finish the year about 10% year-over-year home price gains for 2022. And we're set up, though, for basically zero home price gains in 2023. We will revisit that 2023 home price appreciation estimates as the year progresses. And also January, we get real insight to demand for the following year. So lots of ground to cover between here and there first. Because here is the demand indicator that we're watching. The percentage of homes that have taken a price reduction is up to 38.4% this week. 38% of the homes on the market have had a recent price cut from their original list price. Every year in August, price reductions climbs. It climbs weekly. That's totally normal. But you can see the curve here in the dark red. The pace of the newest price reductions each week, that seems to have turned the corner. So you can imagine how this curve plays out for the rest of the year. 39% next week, 40%. The market's going to be in the low 40s before it starts receding and resets for the beginning of the year. This is high. It illustrates that buyers have backed away off the frenzy of that first quarter, but it also shows that things aren't deteriorating from here. Surprisingly tight inventory, so buyers are buying their best stuff when it's priced right, and those price reductions don't need to happen. Those properties are moving. Price reductions in some of the hottest local markets are pretty crazy, though. Boise is up to 60% this week. 60% of the homes on the market in Boise have had a price cut. Phoenix is 58%. Austin, Utah, Florida, Denver. These markets are all 50% or more of the current stock has had a price cut from the original list price. So these are pretty bearish conditions for future transaction prices in these metros. These are all investor-heavy markets, and the investors have pulled back much more completely than the owner-occupier buyers, it looks like. So these are all destination markets for the California buyers or the New York buyers. So I wonder if that remote work migration has slowed, maybe as people are more apprehensive about recession or having a job in the future. I don't have data on migration, so I'm just speculating here. But conversely, the central and northeast markets are actually humming along much more smoothly than those big investor markets that I just mentioned. So are these hot markets, these formerly hot markets that halted, are they the canaries in the coal mine for the rest of the country? Or are they simply suffering that bullwhip effect that we've seen in so many of the other volatile financial markets around the world as a result of the pandemic? So shifting from one extreme to the other. I tend to think it's the latter. It's not the canaries in the coal mine, but it's more like a bullwhip effect happening. So if this is the case, then this slowdown continues hard right now, but maybe next spring we see it much more normal circumstances. The whip is done cracking, as opposed to some downward spiral or contagion across the country. That seems likely to me. We can see more when we look at this demand indicator of the pandemic that we've been reviewing, the immediate sales chart. The dark portion of each bar here is the volume of new listings hitting the market each week. The light portion of the bar are those that went into contract essentially immediately after listing, days or hours even. So the most striking thing about this chart is the slowdown in the new listings after the July 4th week. You can see the last 5 bars on the right side of the chart here. In June, we were speculating that some of the rapid increase in inventory was, sellers rushing to list before that things got worse or too late in the year. Now it's later in the year, and very few sellers appear willing to test the waters. But fewer listings means a constricted market for buyers. It's a surprising turn. I expected significantly better opportunity for buyers this summer, and it's been a bit better. There's fewer bidding wars, less competition, but it's not actually great. So my suspicion is that the buyers in the market now might be surprised by that. The summary here is this chart really illustrates both the demand side subsiding, the smaller light colored portion of the bars, and the supply side subsiding, the smaller dark portion of the bars each week. So if you have buyers and sellers looking for guidance right now, make sure that you show them the data so they can see for themselves what's happening in your local market. So even in those most hard hit markets that I mentioned, we can see this slide turning the corner. Your buyers and sellers may need to know that right now. Go to altosresearch.com and sign up so you can get the data in your hands and in the hands of your clients today. So that's all the time we have for today. More next week.